Central banks play a critical role in ensuring monetary policy and financial stability within an economy. Their primary objectives include maintaining price stability, promoting sustainable economic growth, and safeguarding the stability of the financial system. Central banks have various tools at their disposal to achieve these objectives, and their actions have significant implications for the overall health and stability of the economy. Monetary policy. One of the primary responsibilities of central banks is to formulate and implement monetary policy. Monetary policy refers to the actions taken by the central bank to manage the money supply, interest rates, and credit conditions in the economy. The main goal of monetary policy is to maintain price stability, which is usually defined as low and stable inflation. By controlling the money supply and interest rates, central banks influence borrowing costs, investment decisions, consumption patterns, and ultimately aggregate demand in the economy. Central banks typically use a combination of tools to conduct monetary policy. These tools include open market operations. Central banks buy or sell government securities in the open market to influence the money supply and interest rates. When the central bank buys securities, it injects liquidity into the system, reducing interest rates and stimulating economic activity. Conversely, selling securities reduces the money supply, raises interest rates, and slows down the economy. Reserve requirements. Central banks mandate commercial banks to hold a certain percentage of their deposits as reserves. By adjusting these reserve requirements, central banks can influence the amount of money banks can lend and, thus, the overall money supply. Policy interest rates. Central banks can directly influence short-term interest rates through their policy rate, such as the federal funds rate in the United States. By adjusting the policy rate, central banks can signal their stance on monetary policy, influencing borrowing costs and investment decisions. Forward guidance. Central banks provide forward guidance on their future policy intentions and economic outlook to influence market expectations. This guidance helps shape market interest rates and can influence long-term borrowing costs and investment decisions. Financial stability. In addition to monetary policy, central banks are responsible for maintaining financial stability. Financial stability refers to the smooth functioning of the financial system, where financial institutions and markets are resilient and can withstand shocks without widespread disruptions. Central banks monitor and address risks to financial stability to prevent systemic crises that could have severe consequences for the economy. Central banks promote financial stability through the following actions. Supervision and regulation. Central banks oversee and regulate financial institutions to ensure they operate prudently and manage risks effectively. They set and enforce capital adequacy requirements, liquidity standards, and other regulations to promote the safety and soundness of banks and other financial intermediaries. Lender of last resort. Central banks act as lenders of last resort, providing emergency liquidity to solvent but illiquid banks during periods of financial stress. By providing liquidity support, central banks aim to prevent bank runs and mitigate systemic risks that could spread across the financial system. Macroprudential policies. Central banks employ macroprudential policies to address systemic risks and vulnerabilities in the financial system. These policies include measures such as capital buffers, loan-to-value ratios, and stress testing to mitigate excessive risk-taking, asset bubbles, and potential contagion effects. Crisis management. In the event of a financial crisis, central banks coordinate with other regulatory bodies and government agencies to manage the crisis, stabilize the financial system, and restore market confidence. They may provide emergency funding, facilitate bank resolutions, or implement other measures to contain the crisis and protect financial stability. Exchange rate management. Central banks also play a role in managing the exchange rate of their domestic currency. They may intervene in the foreign exchange market by buying or selling their currency to influence its value relative to other currencies. Central banks aim to maintain exchange rate stability to support trade, investment, and overall economic stability. It's important to note that the specific roles and responsibilities of central banks may vary across countries and regions. Different central banks operate under different legal frameworks and have varying degrees of independence, which can impact their ability to implement monetary policy and ensure financial stability effectively.